Hello and welcome to this presentation with Maha Energy. My name is Carl Fredrik Schjøtt-Pedersen. I'm the equity research analyst with ABGSC covering Maha. With us today we have the CEO of Maha Energy, Jonas Lindvall, and he will present the equity story to you all, and then subsequently we'll have a brief Q&A session. So Jonas, the floor is yours.
Thank you, Carl Fredrik. Thank you for hosting this event, and we're pleased to participate. If we can go to slide 3, we can skip the normal disclaimer, and I want to spend a little bit of time on this slide because it sort of identifies what we are, gives our DNA of our company. So we are in the energy sector, for those of you who do not know, specifically in the oil and gas sector. We're an upstream junior oil and gas company, and we obviously produce oil and gas. We are active in 3 countries, and we have 5 producing assets. 3 producing assets and 5 assets. In particular, I want to spend a little bit of time here going through what sort of sets us apart, what we're different. So first off, we operate all our assets. We believe that by being the operator, we can control our own destiny. We set our own schedule, and we can control the capital spend. So that's very important when you're building a junior company like Maha. Secondly, one of our core principles is what you see down there on the left-hand side of the screen on the slide. Is we have a very robust asset base where we split our assets into 3 categories. Primarily, we want to build our company on the fundamentals of exploitation. So we're not an exploration company. We are an engineering company. We apply enhanced oil recovery technologies. We bring engineering skills, and we're very, very strong on the subsurface. So essentially 90% of all our assets in our portfolio are producing assets. They should be low risk, what we call brownfield developments. Our growth comes primarily from our middle segment there at 40%, the 40 in the strategy, where we seek out and find underperforming hydrocarbon assets, and we apply technology through our skill set to grow our business. So it's a very low risk business that we're building. We do not spend a lot of time trying to identify exploration targets. Instead, we spend our time in exploiting those already found hydrocarbons. The 10 on that 50-40-10 strategy is a little bit of what we would call near field exploration. So that would be, for example, bypassed reservoirs, smaller traps very nearby our existing infrastructure. So we're a very sort of closed, fenced-in company. We tend to stick to what we're good at, which is in the exploitation arena. So if we go to the next slide, please. So any oil company, we base our growth and our cash flow through our reserves. You can see on this slide here, we are active in 3 countries, United States, Brazil, and Oman. We recently added the Oman Block 70 to our portfolio, and that completed what I call our 3-legged stool strategy, where we want to be diversified across at least 3 jurisdictions. And that's important in our business because, things happen, political risk, financial risk, new tax laws are introduced, so you don't want to have all your eggs in one basket. So we set on very early in our building our company, we decided that we wanted to be properly diversified across 3 stable jurisdictions. If we look at our reserve growth over the past 4 or 5 years, we can see that our 2P or proven plus probable reserves have consistently grown across that time. Right now we have about 48 million barrels of reserves, 2P reserves, and the majority of those reserves are in oil. About over 90% of all our assets are oil producing assets. We are a listed company. We started out in 2013 as a private company, And in 2016, we entered the First North bourse in Stockholm. And as recently as last year, we've migrated up to the main market, the main board in Stockholm. Current market cap is just over 1.5 billion SEK, and our current production is just over 4,000 BOEs per day. We'll go to the next slide, please. So this slide is very busy. It sort of tells the story. This is the roadmap of our company. It tells, gives is our sort of health check dashboard. So if we start up on the left-hand side and work our way around it, you can see our production growth. Since 2016, we have quadrupled our production. We started in 17 by just under 1,000 BOEs per day, and we exited 2020 at over 4,000 barrels of oil per day. On the right-hand side, you can see 2020 split up. Now, 2020, of course, has been a very tough year for all of us. We are no exception to being hit by the pandemic. You can see that towards the end of 2020, our production suffered. We had a number of technical issues that really hit us quite hard. Now, I must say, though, that, and this was not done on intention, of course, but we managed to follow the oil price curve down. So when oil prices started recovering, we had fixed all our production issues in Brazil, and we were increasing production. So that's a bit of a silver lining to our troubles of the second half of 2020. If we go straight down below there, we have our operating cash flow, and our operating costs are relatively low in the industry standard. Current production costs are between $7 and $8 per barrel. And that's reflected in a very healthy netback that you can see in our sort of bottom left-hand corner of the slide. We currently, the 2020 netback was just over $20 per barrel, which is very healthy considering that the average oil price for 2020 was just over $40 per barrel. So at $60, $70 per barrel, which it is now, the oil price, we are enjoying very strong, healthy netbacks and generating good cash flow for the company. Go to the next slide, please. So next slide, please. If we, we have to go back one. T-field, yes. So I'll spend a little bit of time going through our assets, which is really the fundamental driver for our business. Before I round up and tell you a little bit about our future plans, we actually released last night our 5-year strategic growth plan and can be found on our website. First off, we are, like I said, we're active in 3 countries. We have 5 assets spread across 3 countries. The crown jewel of our assets is located in Brazil. It's the T-field. We acquired this back in 2017. And when we acquired it, it was producing just over 1,200 barrels per day. Today, we're doing well over 3,500 barrels per day, and we're growing this asset to a peak of 4,800 barrels of oil per day. It's located onshore in the state of Bahia. We produce from 2 separate sandstones, so we have some risk mitigation there in that the 2 reservoirs are completely independent of each other. We've spent the last 2-3 years to upgrade the facilities. We have also secured offtake agreements for the oil that we produce there. So this is our cash cow, is what I like to call it. We've spent the majority of our cash upgrading facilities, drilling wells, establishing offtake agreements, and also securing gas offtake for our associated gas. So that's moving into a harvest mode, as can be seen at the bottom of this slide, the capital plan for 2021, which really just entails drilling more production wells and water injection wells. Whilst we stay in Brazil, we can go to the next slide. We also operate the Tartaruga Field. Tartaruga is, the field is just up the street from the T-field in the next province up, also onshore. This was our first acquisition in Brazil. And this is an interesting play. It's more of an appraisal slash development play than the T field, which is squarely in the harvest production mode. It's got 3 wells on the structure, and it's denoted by basically the Pinedo sandstone having over 27 separate layers of oil-producing sands that contain some measure or not of hydrocarbons. This field is currently producing on a gross basis about 500 barrels per day. We have 75% of this. We drilled a well back in 2020 and tested a well here, and the idea is to spend some more time evaluating this structure before we move into further development of this field. Next slide, please. That rounds up Brazil. We have, like I said, we have 2 fields in Brazil. We recently added our 3rd leg to our stool. We diversified into Oman. We were successful of a tender process there that started in 2019, and this is Block 70. So Block 70 is right smack in the middle of central Oman, also onshore. We operate this block. We have 100%. It is surrounded by multiple large oil-producing fields that have been producing it for a very, very long time. The notable feature of Block 70 is it contains an already discovered and appraised oil field called Mafraq. Mafraq was discovered back in 1988 by Shell, and it has been delineated by 3D seismic and a total of 5 wells, along with 2 production tests, of which one was a long-term production test conducted by Shell. The idea for this is for us to go in and develop this field. It's very shallow. It's only about 500 meters deep, and we believe that the horizontal drilling is a very successful technique that we can apply here to extract this oil at a relatively benign cost. We're very excited about this addition. It is a large field. It contains anywhere between 180 and 280 million barrels in place, maybe more. And we have currently booked contingent resources of just over 22 million barrels. And the contingency there is the approval of the acceptance of a development plan by the government of Oman. For 2021, we are establishing our presence in Oman, and we will be buying long lead equipment for our drilling campaign in 2022. Drilling will consist of anywhere between 6 and 10 wells to begin with, and after we evaluate the results of those wells, we will move into a full field development. The idea is to take this field to 9,000 barrels per day on a plateau basis if our pilot project is successful. Next slide, please. The last place where we're active is the United States, and we used the COVID-19 crisis to our advantage. There were quite a lot of distressed assets going through the sales process back in 2020. We picked up a producing asset in the Illinois Basin. Compared to all the other assets we have, this is relatively small. It only has about 3 million barrels of recoverable oil in 2 PKs. But it fits very well into our portfolio in that it's very low risk. We have 3 independent reservoirs producing. So if 1 or 2 reservoirs are tight or off structure, there is extra safety in having those stacked reservoirs. It is a very predictable in terms of area wise. It's very predictable. It's almost like a manufacturing process here. There's well over 2,000 wells in this area, so the stratigraphic control is extremely good. And we've identified over 100 future drill locations on this asset. Very, very cheap. We can drill a well here for about $650,000. Each well will yield about 65 to 75,000 barrels. So you have to put this as a very, very low risk, relatively medium to low return on that investment. But like I said, it really forms a good foundation to build a company on, generate sufficient cash flow, particularly at these oil prices. And then last slide, please. Last but not least, we have the LAK Ranch. This was the asset that we founded the company on. Currently, it is shut in. LAK Ranch is located in Wyoming, and it's a heavy oil, a 19-degree API, which is it's quite significantly heavier than what we produce in Illinois Basin. Illinois Basin, it's a 35-degree API, very light oil, very good quality. Here we have to work a little bit harder for our oil, and this is purely an oil price play more than anything else. At $40, $50 per barrel WTI, we will not make money here. At these levels, we are looking at re-implementing the investment process in LAK. LAK contains well over 60 million barrels in place of oil, and that is well proven by multiple, well over 50 wells. The oil is there, the trick is to get it out there commercially. So with that, you can go to the last slide, but that concludes my presentation for today.
Excellent. Thank you, Jonas. I guess there are quite a few questions popping to mind, especially given your growth history and the ambitions that you do see forward. Let's start off with the growth expectations and trajectory. Are there any? What would you identify as the main risks to be able to perform your production outlook in accordance with expectations?
Well, we've spent the last 2 or 3 years building our asset base, and I want to go back to sort of our core strategies that we build our company on, which was one of which was this three-legged stool. But really, you need high-quality assets to be able to grow your business. We stay onshore, and and that's really to mitigate risk, financial risk. The cost of overruns onshore has a much lesser effect than, say, when you're operating offshore. But to answer your question, the main risk I see is operational risk at the moment. We've amassed a great foundation for the company. We have world-class assets in Oman and in Brazil. We hope to grow our business further in the United States. It's a more competitive market there. But the main risk right now is with the oil price having recovered, is operational and execution risk.
And drawing further on that, how is the operational environment, especially in Brazil, given the current status on COVID-19? Is it your experience that is becoming easier, or is it still quite tricky?
Brazil is a plethora of different issues, I should say. Some of them good and maybe some are more challenging. But with COVID-19, no question, we were hit quite hard because we are reliant on a lot of third parties in Brazil. For example, our gas offtake was completely shut down in the month of April, and that impacted us because we had to reduce production because of that. Borders have been closed. Municipal level borders were closed. The movement of people and goods have been impacted, not only internationally but also domestically. So COVID was a real challenge for us, notwithstanding the impact it had on oil price, of course. But when you're looking at it logistically, it has been very tough. Now, we have put in place lots of procedures for us to mitigate that. For example, we're currently drilling. We do daily COVID rapid tests on all the sites. We implemented a third string on our operational staff, so that if one crew got sick, then we would have ample bench strength to follow up. Those are just some of the mitigations that we put in place, but there's no question it's been very tough.
I guess that's the story for most companies, so it's fully understood. It's more if it has evolved or not. Thank you for the update. If you look to Mafraq, this is a huge field in terms of oil in place, as you mentioned, between 100 and 200 million barrels. And then you have booked on a contingent basis 20-some million barrels of contingent resources. The question from my end is two-parted. First of all, you currently hold 100% working interest. Is that something that you'll farm down over time, or do you anticipate to continue to hold such a large stake? And the second question is, what is the potential for the recovery rate for these types of fields over time? Do you feel that the current resources booked is representative of the potential, or is there substantial upside potential?
Right. So the first part of that is we have already been approached by 3 parties for farm down. So we are definitely considering farming down, but we are not going to go less than 50%. I mean, this is a significant asset for us. It's a great opportunity, and we're extremely bullish on this. Why do I say we're bullish? It will lead into your second question, and that is we have an incredible amount of information. I used to work for Shell. In fact, I used to work for PDO or Shell at the time, back in the late 90s. I know this area extremely well. I know this field quite well as well. So the information quality that we have on this asset is unbelievably extraordinary. So that gives us great confidence in what we believe we can extract. So it is a heavy oil play. It's very shallow. It's only about 500 meters deep. It has been delineated by 5 wells, 2 horizontals, one vertical test and 1 horizontal test, all without the use of heat. So this crude oil cold flows and reservoir conditions. That's not to say it's not without challenge. It is with challenge, but the main criteria for this oil is that it does move without the application of further energy. So with the advent of modern pumps, particularly here from Canada, the sort of the heavy oil capital of the world, unbelievable strides have been done in pump technology. So we are very confident that we will extract this oil economically at high rates without the use of heat or energy. Now, if we were to provide heat, then the recovery factor would definitely increase. So there's 2 parts to this, and that is, of course, the recovery factor, which can be increased by the application of energy/heat. The other is the size. Now, the in-place volumes I have mentioned to you are not the oil-water contact in this field has not been determined. So the numbers that we have is what we call oil down to. So there's further upside to those numbers. And that's one of the first things that we intend to do, is to try and go hunting for that oil-water contact so we can really determine what the true size of this price is.
Excellent. So it does sound like there is potential for positive revisions if your development plan turns successful. So that's sounds good. Two final questions as time is running out. The first, could you provide an update on your financing? You do have a bond maturing in May. You have announced that you have a bank agreement on the way, or that has been firmed up. And you also have a grace period for a further bond process. Could you, 1, tell us about the current status, and 2, given where the oil price is at the current levels, are there any risk as long as financing is in place that we could see mid-year revisions to your spending plans?
Great questions, and I'll try to be very quick. So you're absolutely right. We are in an exclusivity period with a bank, and that's progressing extremely well. The technical due diligence has been completed, and it is our hope that we will move into final documentation, hopefully by the end of this week, maybe early next week. That depends about their internal investment committee. We are also in parallel to that, like you noted, we have part of our agreement with this bank is that we do have the right and the authority to discuss with our existing bondholders with respect to potentially an amended bond option, and that is also going on as we speak. And I think that hopefully this week we will be able to reach out to existing bondholders with a potential proposal. So we are running both tracks, and I'm absolutely confident that come May 29, we will have this refinanced. With respect to revision of capital spending, I think given the current oil price scenario and our positive traction in the financing market, I think that's very possible.
Excellent. With that, we are running out of time. Thank you so much for your presentation, Jonas, and very interesting to follow Maha and the growth story in the time to come. Thank you for your presentation.